So after very interesting insights into the market for GP-LEDs, and I must say I want to commend Greg Holden for being very honest with his answer to my question, because most buyers usually not so candid about what's happening in their portfolios. So bravo. So moving on to the LP-LED market, I think it's certainly been an interesting comeback. I mean, 2020, 2021, it was all about GP-LEDs. And I think people had a bit of sentiment that LP-LED transactions were a thing of the past. But we have certainly seen that that part of the market come back pretty strongly. So we have a very distinguished panel here. Kerry Lodge from Common Fund, who heads the secondary activity. Markus Benzler from UBS Asset Management. I'm not actually sure exactly what your title is, Markus, but Head of Private Equity. Okay. And then we have Guillaume Collier from Lexington, and Kim Pochon, I hope pronunciation is correct, from Unigestion, which is a Swiss-based asset manager. So I'll kick it off, and we obviously, the question is how active was the market in 2022, and we saw from the obviously a few stats I presented earlier, but it perhaps Guillaume, I don't know whether you want to start with that, what you saw in the market, and then perhaps I don't know, Kerry, then if you want to talk a little bit, because you're in slightly different segments of the market, I would say.
Yeah, no, I think just generally speaking on the secondary, yeah, great. So what we've seen last year, we've seen a market that was 100 billion. It was slightly down from around 128 billion the previous year. And there is a couple of reasons for that, a couple of good reasons. Number one is just the fact that we're targeting a market that is highly undercapitalized on the buy side. So the amount of dry powder available to tackle the market is about 1x, and that's about what we've seen in our history being in the market for more than 30 years, a sort of an all-time low, which brings a lot of opportunity certainly and creates a buyer's market for us. So that's one of the reasons. And then we've got a bit of a bumpy road, and I think valuation are adjusting, and it's very natural that offers and pricing expectation does not necessarily always matches, and that sort of creates a temporary sort of slowdown in the market, and we've seen that in 2008, and then 2009 was another sort of very good year. So that's sort of very natural for us, and there were no sort of big surprises.
Yeah, I'd say at the small end of the market, deal flow is a bit more consistent, just because it doesn't take a lot to move the needle for us in terms of small transactions. Obviously, the first quarter of 2022, we saw deal flow still coming through from 2021. And then there was a lag in the second and third quarter as sellers got more used to the discounts that they were going to have to take. So I think if we look at overall in the market, there weren't very few transactions trading at par or premium, and most good funds were trading probably 10 to 15% discount, and a 20% discount became a 30% discount. And venture, you're probably even seeing 40% discount. So given the lag in marks on the private equity market, we did see a bit of sellers having to get used to the price location. But the denominator effect is real. Sellers are out there and they need to sell. And I think in markets of volatility, the LP market tends to have more supply than the GP-led market. In the LP market, I'm gonna disagree a little bit here, or say will always be part of the secondary market. It's a very key core piece of the secondary market. So go LP transactions; they're gonna always be here. If you just look statistically at how many funds are raised in a given year, it's probably 3,000 funds in a given year. So if you think the average life of private equity is 15 years, you're talking 45,000 funds. And even as busy as all our brokers are in the secondary market, I don't think they can take 45,000 funds or anywhere near that out into the market. So the LP market allows LPs to manage their portfolios from their perspective, whereas the GP-led market is more of a solution for all the LPs within a fund. So I think they serve very different purposes in terms of liquidity solutions for LPs, and therefore you've seen in over the last 3 years, I'd say the market's probably split about half and half between LP transactions and GP-led transactions, and I think largely they'll continue both to grow given all the private equity that has been raised in the market.
Marcus, for you as a buyer, what were kind of the key considerations as you were looking at opportunities out there?
Yeah, so we last year also looked at a lot of GP-led transactions. We are smaller buyer, small mid-market focused buyer. In LP stakes, I think we also shifted to the GP-led side last year because we felt, especially when it was larger LP stake portfolios with like whatever 10, 15 line items, and then you had a lot of underlying companies. In some cases we knew the underlying portfolios, but in many cases we did not know well enough the underlying portfolios, so we weren't comfortable with the valuations. So based on that, we didn't know if we can get comfortable with the valuations in the time we had left to evaluate the transaction. So at the end, we moved to the GP-led side for quite a few of the transactions. And then even there, we focused usually like really very small portfolios as opposed to larger portfolios, just to make sure we get it right in the current market environment.
It's funny, it's interesting because we certainly had maybe a slightly different view. I think our view is we don't have a crystal ball, but what we've learned over the years, 30 years, Lexington has been created in 1994, and investing through the cycle, it feels a little bit bumpy down there. So we've decided by design to deploy 80% of our capital in LP transactions, and there is a good reason for that. It's just we're trying to create what we call a defensive portfolio. And what we can get through the LP books is, diversification, discount. We can pick and choose and do the quality check here. And that's what our LP wants, and that's what we've been focusing on. And I think, as I mentioned earlier, it's a buyer's market, and we're able to flex on terms. So, for instance, deferral has been clearly, and I think that's maybe one of your questions for later.
Depends with which advisor.
But that's something certainly we've been using, and it's been a great way for us to structure deals.
Maybe let me comment. We have typically in the size range we're looking, let's say, between a couple of million and maybe 100 million transaction sizes. You don't have the well intermediate processes, but you have like one-man shops or partly no transactions. So one of the main drivers is obviously the certainty that this transaction then happens. And if you had a feeling that there's a huge buyer mismatch, buyer-seller price expectation mismatch, then it's also obviously one of the reasons why we say, well, we do not go ahead with the transaction, right?
If I just also may add that I think we've seen also, because Unigestion a bit like Common Fund, also a bit more focused on the small mid-market. And so, we don't focus on buying large LP stake portfolio, but kind of focus on a couple of lines. And I think, I don't know if I can use this expression, but we've seen a bit, a lot of GP-led LP stakes, where for single line sell, the sellers come to the GP, they know the GP, say, hey, can you go to people, to your existing LP base? Can you go to your network, people close to you that, who can see the value, who maybe can price it a bit better? And then, of course, the GP had a stronger hand on the process, or sometimes was a bit running the process if they were so in fundraising. And that's a trend I think that we have seen increasing more, at least on our, let's say, in our part of the market. And that's always quite surprising, or you end up in very funny situations, I have to say.
Yeah, I'd say we were buying more specific GPs, but as I mentioned earlier, there are probably 45,000 funds out there. So the secondary market is still nascent. We're trading less than 2% of the overall market. So even in a market like this, when we say distributions are slow and you're buying tail end portfolios, you're still getting distributions back on a lot of the things that we're buying. So, we're buying a bunch of funds right now where, the company is sold before we even close the transaction because they're so old. So there's still distributions coming back to the private equity market. And in the secondary market, only the transactions that are, working for both the seller and the buyer are transacting in a market like this. And a lot of times those transactions do have a lens into liquidity.
So, talking a little bit about valuations, and we saw that there is a bit of a gap between where private market valuations are, where public market valuations are, and that has also contributed to increasing discounts. Guillaume, where do you think pricing is going this year?
Yeah, I'll say as well, it was a big driver of certainly pricing, and it was as well a big driver of LPs seeking liquidity because private markets have underperformed and private equity has outperformed, and many of them found themselves in a situation where they were over-allocated to private equity. And that was sort of the denominator effect we mentioned. I think on the pricing, what we're seeing right now is certainly an increasing sort of discounts. We are certainly very focused on that. We think it's a great way to build a very defensive portfolio. So that's certainly, secondary is all about mitigation of the J curve. If you don't get the discounts, you're sort of, I think, missing part of the equation of what makes, secondary very special. And that's what our investors are doing. To answer to your question more precisely, right now, we're seeing trades, 25 up to 35% discount for buyouts. And again, it's a great market. It's a buyer's market. We can pick and choose assets, something we've done very well. We can negotiate discount. We can negotiate default. And it's just by the fact that there is very high barriers to entry on the secondary side, and on the other hand, you're receiving so much deal flow, and it's just been great. So again, dry powder being very low, that has allowed us to negotiate pricing accordingly.
But I would also say discounts are high because if we took a survey of this room, I bet you most of you aren't expecting a lot of liquidity in the next year. You're expecting exits to be further out. You're expecting multiples to come down, right? So if you think of how you underwrite a portfolio, you were predicting out when the company's going to exit, what multiple it's going to exit at, how much the company's going to grow, and all of that, everyone's expectations are lower. So if everyone's expectations are lower and you're discounting it back, you're going to have a higher discount.
What I would say from an advisor perspective, obviously, buyers are preaching a little bit their own story here. But it is true that obviously there are larger discounts. But what we have certainly also observed is that the gap or the standard deviation between bids for the same assets has increased. And so we had one relatively large sale process a few months ago where ultimately the portfolio traded at a single-digit discount to June numbers, but the spread between the high and the low bids was 20%. So there were people who were essentially bidding at 70% and others who were at around 90% plus. And so I think it just shows that partly there is different expectations around performance of these portfolios, different expectations around timing. And certainly those funds were all well-known large cap funds. So we generally maybe see 5% in normal market times, between high and low bids on such portfolios. And we've just seen that these spreads have increased dramatically. So if you're thinking about selling, it's certainly worthwhile to have a well-run process and make sure you're not selling to the party who is obviously at 70%. So I think that's an important message also, I think, here.
I completely concur with that. One comment I want to make on what you said, what we also saw is that a lot of the sellers, especially if it's like CIO level decisions, they were last year reluctant to then let go secondary portfolios for high discount because they already had a lot of losses on equities and whatever parts of the portfolio. And this year, I think they have a very different stance that they say, well, this year I can swallow, but last year I just couldn't swallow to have another major hit on my portfolio. And there, the good thing is obviously private equity is a bit slow in adjusting the valuations.
And also, just to come back also on the valuations, I think will be quite interesting to see how pricing will react, because of course, I think Q4 valuations will be released soon. I don't think that they will be, again, since valuations are quite smooth in private equity, I don't think it will make a big drop up. I think it will be rather flattish. However, I think what can maybe change is that those valuations will be audited, because most of the funds have year-end audits, and maybe it will bridge a bit the gap between sellers and buyers, because again, an audit is an audit, but at least you have a third-party view, and maybe some GPs who kept a couple of companies a bit high. Maybe the auditor will say not now. So it'll be very interesting to see how the market reacts.
I'll come back to your point. On the discount, I can say, we were some of the bottom fishers. We did bid on some of those deals at sort of 70 to NAV, and there is a reason why. On top of what you just said, which is very true, in this environment, we've as well decided just to increase the returns we want to see for deals. We're just raising the bar internally, just because we feel there is, significant risk out there. As I mentioned, the amount of dry powder available to provide liquidity to LP is very thin, and therefore we think that deserves a premium, and the premium transforms itself into some discount, because that's sort of a liquidity discount you need to get. That's sort of very natural, and that's what we've done. But we've deployed 7 billion last year on the secondary side, so we were able to do good deals, and hopefully, but we transact nonetheless.
Come to the right advisor. Okay.
Yeah, but Bernard is certainly
anyway,
very talented.
So I wanted to talk a little bit also about what has been transacting. So we obviously often talk about buyout, which is still I would say the largest part of the market. But what about other strategies, infrastructure, private credit, venture growth, carry? I mean, what have you been buying last year?
Yeah, I mean, I think the majority of what we're buying is U.S. buyout, because it's the least risky, and as was spoken just a minute ago, capital is tight, and there's a lot of opportunity in the secondary market, and we get to pick and choose our spots. I think venture capital becomes a bit more difficult, because liquidity across the market, across everything, is expensive right now. So if you have companies that need another financing round, they're going to see their valuations come down, and the rounds are going to be lower. So we're very cautious when we're buying venture portfolios. Do those companies have enough cash to last another 2 or 3 years? Can they grow into their valuations? Or are they going to need a new financing round, and you're going to see a big drop in the valuations of those companies? So I think that makes venture a bit more difficult. I think buyout is a bit easier to get your arms around. And since there are so many transactions out there, the supply is quite good in the secondary market. If you just look at where the secondary market is growing, we haven't even touched on that, but the market is easily going to double in the next 5 years, just based on the amount of private equity that's been raised. So this resource constraint is only going to get worse. So we're focused mostly on U.S. buyout, but energy has been an interesting spot for people to invest, because the energy funds are very cash flow driven right now. So we bought an energy portfolio, and we saw 50% of the purchase price come back in cash. So you are seeing energy having a lot of distributions right now. So it could be an interesting play. It's a very small part of our portfolio, though.
Marcus, I know you guys have also a lot of expertise on the infrastructure and real estate side. Have you also been active in those areas, or not so much?
So we have a dedicated team on our platform, so independent primary and secondary teams for all of these sub-asset classes. I would say on the infrastructure side, we would like to see much more than actually what we saw. So the team has done mostly primaries and co-investments, and still very little on the secondary side, and much less than they want. What we have seen on the private equity side, a lot of private debt mingled in private equity portfolios, LP stake deals, which we don't like so much, because we have a private debt, but it's a capability, but it's a different team, and they are quite focused more on primary funds these days. And then on the real estate side, yeah, well, there was also quite a bit on the market as far as I know from the team. So definitely. And then for your questions, I mean, we have done also only buyout for the same reasons. We feel very comfortable on the venture primary side, but for the reasons just said before, we didn't like to touch the portfolios. We did a lot of buyout, but mostly Europe, because from the years before, prior, we had done a lot of US deals, so we felt it's for balancing out the portfolio, more Europe is the place to be.
And Kim, have you also been buying mostly buyout, or?
Yeah, so the strategy of Resurgence, we do only private equity, so no infra, no debts, but I think going a bit more granular, we've been mostly focused on buyout. We looked a bit at secondaries in the VC and also growth space. But here, I think, and that's also a broader topic, that it's also a bit tough to time the market, because in a market when valuations only go up, from a buyer perspective, you have all the incentive in the world to really try to transact and lock that value before the valuations go up, and then the deal is not good anymore. However, in a downward market, you always wait to get the latest info to incorporate it into your model. So you always wait the last minute before, because it's a bit unpredictable. So that's why also we've looked at a couple of growth, couple of VC, but I think we haven't transacted. So mostly buyouts.
And I'll just add one word as well towards maybe. We've been, of course, very focused on buyout Lexington. That's certainly one of the key, but venture has been a very interesting part of the market for us for a number of reasons. Number one is we've been doing VC since 1995, so the firm was founded in 94, so really it's been in our core DNA. Number one, so we've got great expertise. We feel it's a part of the market where I think the asymmetry of information is higher. If you look at a venture fund report, there is not much information on the companies, so to due diligence and to be able to get to the bottom of it, you need to cross-reference check with other people that are sitting on the cap table, and to be able to do that, you need to have the access. And so we've done that because we feel venture is a great way. So a little bit it's actually very complementary to buyouts. It's a nice way to untangle, very large deals where you have buyout and you have a bit of venture, and so you can provide a full solution to LPs. And I think we've played that card very well. So that's a part of the market. It typically represents 15 to 20% our funds, but we have a team in Menlo Park that do that, and we've used them for that purpose.
Moving on and talking, we obviously spoke about the valuations and the gap, expectation gap also between buyers and sellers. I mean, we've certainly seen deferred payments play an important role. So I don't know what, Guillaume, whether you can, have you been keen on getting deferrals from sellers, and what's been the type of terms which are, which you would like to see?
I mean, in a rising interest rate environment, I think it's a great way to contractually protect your IRR in deals. It's free of any charges, it's free of any amortization. So we've been looking at those structures very, very accurately. I would just say I can give you a stat. Out of our latest fund, so we're deploying this fund 10, 43% of the purchase price that we've negotiated have default structures, and those ranges from 1 to 2 years, and so that's what we've done, and yeah, so it's been a great way to create some defensiveness in the portfolio.
Yeah, I think again, that's also, I think also since the sellers, a lot of the sellers, it was more about rebalancing the allocation, offload also a bit of exposure, but they were not in liquidity crunch or liquidity needs. So of course, it was at the end for them, it was about price maximization. So also deferred payment flies extremely well. Also trying now to also have not an earn-out, but kind of a payment or a deferred payment, but conditional on getting some liquidity, where actually then the sellers take a bit of risk of the timing of what they're selling. So that's also something we're trying to incorporate into the couple of offers that we can do, and then the sellers just pick and choose.
I just say, I mean, deferred payments are great, but at the small end of the market, I think there's less leverage being used, so there's less of a need for deferred payments, and the transactions are small, so typically we haven't seen at the small end of the market as much deferrals being used.
Now, one other structure which obviously can provide liquidity without being an outright sale is preferred equity. Have some of you been active in that space or not? Because we have seen increasingly buyers, I think, move beyond just taking equity positions, but moving into preferred. Has that been a topic for any of you?
I think you're going to see more of it if we do have a recession in 2023 and you see more distressed investors. So you're also going to see investors that have invested a lot in the private equity market over the last few years, and they may need to get out of their unfunded commitments. So I think you'll see more preferred equity structures, more earnouts, more just structuring around transactions in a more volatile market. We haven't seen a lot yet. I have made offers of preferred equity and made offers of earnouts, but they're not necessarily the most attractive transactions. So I think it does take a bit more distress.
Same here. Last year, no preferred equity we didn't even use. The years before, yes, especially when we had like growth type of secondary deals and then didn't know where the asset is going, and there it really helped in one case to unlock the transaction, for example. But last year not.
Yeah, I can only echo. We haven't done much, like a bit like Carrie. We have a bit the same view.
Same here.
So yeah, I think we probably expect also this, to play a more meaningful role. Obviously, there have been some dedicated funds for preferred equity, but I think we certainly seen other players also move into that space. Are there any other, developments LPs should watch out for? I mean, one comes to mind, which is changes in U.S. tax rules. And that can obviously impact European sellers, especially on ECI withholding. Have you seen this as a subject of discussion recently? I mean, we've certainly rules obviously changed as of the 1st of January. So now I would say the getting around it becomes a bit more difficult. But I don't know what your experience has been.
Just on that precise point, it's a great question. It's very niche and very technical. But I would just answer it's certainly something we pay a lot of attention to. It's part of our due diligence, and we underwrite funds. We not only look at the assets per asset on a bottom-up basis, but we certainly look at the structure, and we need to make sure that we factor any sort of tax leakage in the projected cash flow in order to make sure we are doing our job properly and projecting the cash flow accurately. So that's very technical, but yeah, that's certainly been a topic, and it's something we're paying great attention to.
Yeah, for those of you who are not familiar, essentially, if you are a non-US investor and you sell, any fund which has US exposure, either a US fund which invests in US, but it can also be a European or Asian fund who has indirect exposure to the US through trading businesses on the ground in the US. There is essentially a 10% withholding tax which applies. Now there are ways to not to pay it because there are certain safe harbor provisions in terms of how much ECI in the last 3 years was generated. But the new rules essentially say that either the GP has to provide a certificate, and while US GPs are more willing to do that, I think we've certainly seen reluctance from European GPs to provide, US tax certificates to sellers. And then the only other avenue is for the seller to issue such a certificate on the basis of K1 statements. But that can get really tricky if you have, for example, a European mid-market fund who may have indirect US exposure but does not produce K1s because most of his investors are European or non-US. So it's certainly an area to keep an eye on if you are a Europe or European seller. I will ask one last question to the panelists, and perhaps each of you can give their view. I mean, how do you see the outlook for this year? I mean, is it going to be as busy as last year, or are we in for, let's say, a bit more difficult market?
I'm optimistic that it's going to be a record year for the secondary market. So I'll go with 150 billion.
I concur. I think what is the plan this year? Fundraising for secondary investors, 100 billion fundraising, 135 billion in capital available, and probably will be north of 100 billion in secondary transaction value. So you can do the math yourself. Is quite of a buyer's market. I would say the other component, at least for us, will be much more active on the LP stake side, and I think the economics will shift in favor to that. So on the GP-led side, if sellers and GP expectations are not coming down, I think the market will maybe, at least for us, get less favorable. But I think the pricings are adjusting already. That's about it from our side.
Yeah, I think I'm also, of course, quite optimistic that there will be quite a good volume also for next year. As we said before, there are all the good ingredients to for people to transact, and just also mechanically, as just private equity matures, then the pot gets bigger, and of course the opportunity pot gets also bigger. So I think above the 100 billion mark, quite confident on that.
Yeah, I obviously agree. I think the limitation is obviously the amount of dry powder we have on the secondary market to tackle the opportunity set. I think there is a lot of demand for liquidity, but I think we're a little bit short. So that's what we need to work out collectively as on the buy side to make sure we raise enough capital to do that. And at the end of the day, we just track the private equity market, and you just seen the private equity market, raising significant amount of capital, and that's the inventory to which we fish, and we and the amount of turnover is increasing. So we've got a lot of positive underlying trends, and the driving force are very structural, and I think it's the simple math, right? And that's what's going to drive, I think, a great market. I think there is much more to come. You're talking about 50 billion. I don't have a crystal ball. I don't know. But what I know is that, in the next 5 to 10 years, it will be multiple of that. That's for sure.
So on this very bullish closing note, I will open it to the audience. I mean, feel free to ask any questions to the panel. Don't be shy. I don't have any Green Hill pens, unfortunately, but... Well, it sounds like we may have covered everything. So thank you for your time and